Welcome back to another episode with Gigi's Talk. When I started my career, when the paycheck would come into my bank account, the moment it enters, then there's click, 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 some amounts that would go off to some debits, like for my card, for my vehicle loan, for my education loan, and etc. At the end, when the it might not be even mid month, and the amount that would be remaining in my account would be this much. So, does this happen to you? In that case, we have an expert with us who we can discuss with on how to welcome Sonal Malhotra. She's an internationally qualified professional who helps with financial building and investment. So, welcome Sonal, and let's hear more about it from the expert herself.
So I am CA Sonal Malhotra. I'm a chartered accountant, also internationally qualified from UCC UK. The rule one should follow for saving as well as investment is 50-20-30 rule. What does that mean? That whatever income you earn as your monthly receipts, be it from business or from your other sources of income like salary, just calculate and budget that what's your post-tax income and divide that income into three parts, which is 50% should be for your needs, which is like the essentials you need to spend on, like groceries, food stuff, rents, bills, EMIs, basically those which cannot be delayed, which are absolutely compulsory. Second, 30% of your income should go to the wants, which are optional in nature. Like suppose you want to get your hair rebonding done, suppose you want to have a Netflix subscription, or maybe you want to do some more expensive branded shopping. So keep 30% of your income aside for that as well. But 20%, remaining 20%, you must keep for the investment part, which you categorically basically aligned to a particular goal. Investment should always be goal oriented, as I always tell to my clients. So, follow this 50-20 rule to ensure that you always have enough for your immediate needs and also gradually fulfill your long term goals.
Okay, so now when we come to that, in our days, at least in my days, there were no coaches and mentors around to tell us how to go about it. What is really investment? There's a difference between saving and investment. I know you could be better to tell us. So, could you please explain the difference between saving and investment?
So, saving is something which is left in your bank account after doing all your mandatory or optional expenses. But investment is which you mindfully do to make your money work for you. It's just not only you working hard, but your money working hard for you. Smart investment options, exactly calculating your risk taking capability, keeping your investment goals in mind, and also diversifying your investments, taking into account that okay, how much money you can lock for a particular period of time and how much returns you are seeking and what risk taking capability you have. You can take the smart investment decisions without draining out of money and also fulfilling your goals.
That means that whatever remains in my account is saving, and whatever I have put out for long term that I will not be touching in the recent coming times will be investment. So, how do you actually budget on a salary that is fixed or something that you can presume that at least this much will be there in my account every month? How do you budget it?
First of all, start with recording. The first and foremost step in a efficient planning is recording all your expenses. Look at your last month's bank account statement and tell exactly record that how much you spend where, and also categorize it that okay, was it optional, was it mandatory expense, and how much you can or you should have saved. Sometimes we just buy the things which we do not really need, and then instead of investing in such assets which depreciate over time, invest in such assets which appreciate in value over time. For example, if I have 1 lakh rupees to save right now, instead if I buy a 70,000 phone out of it, or say 80,000 iPhone, 90,000 iPhone out of it, its value will be hardly 20-30,000 after 2 years of time. And instead, if I invested in gold ETF or say mutual fund SIP, or maybe a smart term insurance or LIC I take, definitely I'll get the risk cover and also get the better returns in terms of value I get after doing this. So it does not mean that you should not invest in expensive assets. Of course, if it is your status symbol and you can earn more out of spending on high phones, but you can get better client deals by showing your expensive phones, then that's a different perspective. You should go about it. But definitely always and always budget separate money for the investment part, and keep your rigorously follow that whether your investment portfolio is meeting your long term investment goals or not.
Okay, so when you are saying that you can buy expensive things, branded things, but keep in mind, is it working to your advantage in the long run? Is it giving you proper returns when you see the long run? Right, Sonal?
Definitely. And you can always, you should in fact always seek the expert guidance of an investment manager. Like I have 13 years experience in financial and investment decisions. I help big corporate clients working with EY and KPMG and big multinationals in taking smart investment decisions, not just for the personal individuals, but also for the companies. So I have that market knowledge. I have that investment knowledge that I can really guide you on where and how much money you should invest, customized to your own.
So, Sonal, what happens is now the market is full of so many options. There are ULIPs, there are mutual funds, there are SIPs, then there are stock market is there, and then you have bank FDs. LIC again is there as an investment option. Also, they are offering certain things. So, how do you decide what to do and how to invest and where to invest?
It's a famous saying, never put all your eggs in same basket. So always diversify. But how to diversify, how much money to invest where, that totally depends on your personal investment goals. That okay, this much money I need after these many years for this purpose. Suppose sometimes even people don't know that okay, I want to get my child to do MBA from USA, but they don't know how much money they will need after when their son or daughter will be at age of graduation. So therefore that you must hire an investment strategist or a personal finance advisor. It also depends upon the risk perception of the people. Like some people are totally risk averse. They do not want to take any risk and just keep the investment safe, even if they are earning lesser returns. Some are like balance. They are okay to take like some risk, but not totally khatro ke khiladi types. And some people are like risk lover, totally risk lover. They see whatever come what may, I don't fear even if I lose 1 lakh in one go. I will invest in the most risky investments. I would just want the higher returns. So people say that the higher the risk, the higher the return. But it's not always. It can go otherwise also. Even if there is no guarantee, even if you take the high risk, you will get the high return. So it totally depends on your number one, your investment goals, number two, your risk taking capability, and number three, your personal financial condition, like how much necessary expenses you have at the moment, and how much responsibilities you have in going forward.
Okay, say for a beginner, Sonal, somebody who has just entered the workforce, their first salaries are just coming in. Can they start their investment journey just when they have started?
Definitely, the power of compounding always comes in the long term investment. The earlier you invest, the better you get. Suppose even if you start a 10,000 rupees SIP from the age of 21, by the time of almost your retirement, like when you are 50, in your 50s, you'll get a whopping 1.2 crores by just investing 10,000 with discipline in a particular good investment option.
So you mean to say that start investing early to get a bigger amount by the principle of compounding.
It does not mean that if you are later in your age, you can't start. Okay. The earlier you realize this, the better, but it's never too late.
Okay. The faster, the better. It's never too late either. So you can start anytime. So when we say that, there are some students also who might just have entered the workforce. They might be having their education loan also with them, with their journey forward. So can you give them some tips of how to manage that and how to use the principles of compounding to their best?
Again, 50-30-20 rule. That since the education loan which they have already taken, that's the first priority, or that will come as a need. And then I don't keep 30% for their wants. Of course, youngsters have much more kind of expenditure which is more optional in nature. So they can definitely have a closer eye upon that and have a rigor to mandatory save at least 20 to 30% of their savings.
When we say that, there are many housewives in India who know how to save. They save from whatever they get for the running of the house. But can you give them some tips of how to go forward? Can they also enter the investment journey?
Well, they can, but I think for a beginner, it's better to consult a personal finance advisor because we are sitting in market for last 15 years or so. So we know how the markets run and what you can expect out of investing in market. But on the other side, as a beginner, if they just invest anywhere by listening to XYZ people, and tomorrow the investment is not going per their plan, they will get scared and just maybe get out of the investment immediately as soon as they see a little return.
Mhm.
So you must take advice of a personal finance investment advisor who can tell you that okay, how much money you should invest, where to invest, and when you should change the portfolio.
So, Sonal, when we come to the advice of a financial advisor, is it a one time investment or does it have to be repeated over a period of time?
Personal finance investment advisor do not charge anything from you. At least me, I as a broker do not charge anything from my clients. It's just on the AUM, the total assets under management by me as a sub broker. I get just 0.5% of the AUM I manage for all the clients. That too from the main broker or the basically the stock exchange, you can say. And I'm not getting anything in particular from the client. Okay. So you can contact me and I will tell you how much SIP and where to invest, and we can start your financial investment journey together.
That's great that you said that it is not per client or something. It is upon the amount of investment done and it's from the brokerage that you get. So is this service available to anyone and everyone, or is there is a criteria for coming to you or to any advisor as such?
Anyone can come to me, and it's not just mutual funds. You can also invest in some LICs. You will not believe I tripled my money in just 10 years with a LIC plan, which is really hard to believe, but I did it. So I can tell you exactly, even some of my clients even developed to 60 times of the investment in 10 years. 60 times. So definitely consult me if you want to start your investment journey, and I'll tell you how much amount will be comfortable for you depending on your personal goals.
One question that comes to my mind is now this stock market is getting on top of the news in all the social media, and the youngsters out there who have just joined the workforce or those who have started earning, say YouTube could be one revenue source, could be LinkedIn, some source of revenue that the youngsters have started generating, because it is not only the job that is providing us financial stability now. There are multiple options around us. So do you have a guidance or do you have some tips for them?
Yeah, definitely. And I don't only, invest upon your one source of income. I exactly tell you how to budget and take into account your all sources of income and all types of expenses, and then make up investment portfolio for you.
Okay. So, Sonal, the one problem that I had faced with my clients that my mentees come and ask me is life insurance or term insurance. Which one would you advise and why?
It again depends upon your goals. If you are seeking insurance only for the risk mitigation, then definitely you can spend your money on term insurance. But remember, whatever you spend on term insurance, not a single penny will come back to you if mishappening does not happen in that period. Even if it's like suppose I you pay 60,000 per year for a health insurance or maybe term plan. So whatever you invest, everything will stay with the company only. Nothing will come back to you. If some, God forbid, death or something does not happen that way. But if you invest in LIC, you have the option of getting the bonus as well as the additional bonus if you invest for a longer period. For example, in an LIC, if you invest up to 10 years, you will get around 20% of additional bonus. But the same, if you invest up to 25 years, that is massively 55% of additional bonus you can get. So that's the benefit you get by investing in a LIC or a typical insurance, with which not only your money is saved because it's government guaranteed, and also it also gives you a good return, also collaborating with the bonus and the additional bonus.
Do you advise taking medical insurance apart from these insurances?
It also depends on the age as well as your medical conditions, and like if you have a good finance cover from your company or the employer, you can think of taking some top ups, or
Okay.
maybe you can plan a separate investment for your parents, for your family, or you can take a family cover. So it depends on all these things. It's better to take an insurance and stay covered than losing chance of money in one day in some medical emergencies.
During COVID, a sudden surge happened. Everybody investing in the stock market. And there were stories of so much of loss around. So, do you advise those beginning to invest in stock market to go by certain rules that they should be abiding?
Yeah, definitely. It's always few rules I've already told, that you should not be relying upon one sort of investment, or it should not be even over diversification. Sometimes people diversify so much that they themselves feel helpless or difficult to keep a track of the investments they have done. So do not over diversify, but do not rely on one type of investment. Also, do not avoid investing for the fear of investing, that okay, oh, my money can go, I can have a loss, I will not invest. It's better to invest even if you face some loss than not to invest. It should not be a emotional or hard investment. X person is investing there, Y person is investing there, so I'll invest there. Do your own research, find a financial advisor, tell them your financial goals, your age, your money requirements, your financial responsibilities at the moment, and your future, aspirations or goals, and budget accordingly how much you should invest and where you should invest. And do not always anyway invest without any financial investment. That's the biggest mistake anybody can do. There's so many things to look upon: CAGR, ROI, NPV, IRR, segmental analysis, preliminary analysis, secondary analysis. So all these investment and do have some importance in taking the right investment decisions. Yeah,
Yes.
these are the six main points I'll say, that do not stop investing for the fear of investing. Do not over rely on fixed as well as market related initiatives. Do not do the emotional and hard investing, and do not invest without any financial investment, at least for the first few years of investing, unless you yourself become a pro in finance. You should take a professional advice.
So now when I started investing, I kept three rules. One, I used to invest in stocks that I use personally, like the toothpaste, like the oil, the things that I use personally. I know it is in the market and how it is going. So I used to keep tab on them, and I would also ask the shopkeepers, is it moving? And then invest in those things initially when I started off. One rule. The second was I would not prefer to go beyond five stocks. I would limit it to 5 to 10 stocks that I can keep track of. And then I would check them almost every week how it is performing. Should I need to change or rearrange or check out on those things? Would you advise that for the youngsters who are starting around? Is that the right way to go, or is there another something you can add to it?
I think rather than investing directly in the market or equity shares, to keep a balanced approach, I think it's better to start in a SIP. Many people confuse that SIP is different and a mutual fund is different. SIP is basically a way of investment. Systematic investment plan means you invest a particular fixed amount of money every month, and that gives you a benefit of, let's say, suppose some seasons the market is high, in some seasons the market is low. So overall, if you invest regularly a fixed amount of every month, that will give you a benefit, in the sense that these seasonal fluctuations will not hit your portfolio. Risk is also lesser in terms of mutual funds or SIPs, compared to directly investing in shares, because when you are investing in shares you are relying only on one company's for business performance. But when you are investing in a mutual funds, they are investing more money in so many different companies which are already performing well, or which the experts believe will perform well in future. So your risk is diversified, your money is diversified. So in that way also it is better to invest in a mutual fund. But again it depends on your risk taking capability. And definitely you must keep some money in your fixed account, fixed deposits, as well as money market or debt related instruments as well, which is completely liquid, which you can anytime redeem easily whenever there is some emergency. It's not necessarily a medical emergency always. It could be a job loss or any other reason for emergency needs. So you must have handy at least 6 to 7 months of your salary or monthly earnings in liquid always.
With that, coming to the end of this session, I would ask you, Sonal, being an expert in financial planning, can you give some tips how to go about with the journey of saving as well as investment for both the women out there and the youngsters out there?
So I would say, if you're completely new to investment, start small. Give a try with, like, say 10,000 per month or 20,000 per month SIP. See the growth over 1 year, 1.5 year, and then once you build trust with the investment advisor, you can probably do a top up on an investment and further increase your portfolio depending on your future needs and goals, as well as your current financial responsibilities.
Give us some advice on about tax planning. Most of the youngsters coming into the workforce recently do not know how to go about it, and there might be certain females as well out there who have started entrepreneurship. Their journey is just new, so they are not aware of when they should start their tax planning. Can you give a little light on that?
Sure. Anybody earning more than 2.5 lakhs in a year is has to pay some tax. But you can always reduce your tax liability to a major extent by using the right combinations of investments you do, as well as intelligently deciding that how much money you should invest in mutual funds. You can absolutely pay zero tax on your mutual fund investments and these SIPs and this thing if you do a certain kind of tax planning, which I can help you with. Tax planning is very important part of your investment journey.
Otherwise, what will happen is when your first salary comes in, you're too excited. And after a certain period of time, when the deduction comes in, you are flabbergasted that where did my money go? So that should not happen. You should plan accordingly. The amount of income that you are having is liable to deduction of tax. So you should work out properly, start planning early so that you do not have to face it in a abrupt manner. So we end this session with the profound knowledge that Sonal said that we should first consult a financial planner and financial advisor to see how much you should need to invest and for what, the kind of journey that you're going ahead with, the plans that you have, and the need of money that you might arise in the future should be taken care of. I think we touched on all the aspects of planning of with money. So if there is anything else uncovered or you think you have a doubt about it, feel free to contact us. The details for Sonal is given in the description below. Do follow us for more. Thank you.